All right, let's get started. Everybody glad to be back. Tell me a question, or tell me an answer. What kind of business do you want to open? Because I know everybody here not accounting majors, right? What type of business would you like to open? Anybody?
An event planning business.
Uh,
Event planning.
Event planning. I may be seeing you, yes, sir. I know I'm gonna see you. A restaurant, so I can go to. No, let me see. I'm gonna eat at your place, then go to the gym. All right, sound good? All right, now in all of these businesses, we need some stuff, right? What do we need? Some who?
Capital.
Some capital, okay? What would we do? We're gonna come back to that capital, but what would we do with that capital? For example, in your business, the gym, and in the restaurant, and in event planning, we need some what? Some money, right? I like that phrase, money. I'm just gonna write money right now. All right? Now, with this money, I know we want to own everything, right? And that's no problem. So, are you going to buy this with all of your money, or are you going to borrow some money? Borrow some money, okay? It's no problem at all. We can do it a lot of different ways. So, if I want to borrow some money, let's say well, let me come down here. Let's say I have some money. Let's say I borrow some money, and we'll just put a little bit of our own in there. Is that okay? Just a little bit, right? Because if it go down, we don't want it all to go away. So, own money. All right, now, what we have here is three important elements. And anybody looked at the work yet at all? If you haven't, I understand, but have you looked at it? Show of hands. All right, good. What did you see there? You saw something about a balance sheet, right? Now, there are some words. I think the most important thing about this class is that sometimes we use words that we normally don't use, okay? Or we use words that we use, but the bank doesn't use them, or other business people don't use them. Only thing about this class, especially for people who are not accounting majors and accounting majors, is to make sure that you know the language. I say accounting majors also because a lot of people just graduate and don't really know what they're talking about. You've seen people like that, right? And so we don't want anybody to be that person. We're going to take this money here, and we're just using these words for now because this is what we're using. You can use them with me anytime you see me, but when you go to the bank, I like you to think of this right here. This money and all this other stuff, we're going to call these assets. Is that okay? Assets. Now, anything you buy, we said we're going to do what? We're going to try to pay for it with cash, or we're going to pay for it on credit. If you pay for it on credit, then you can have a part of it that is a liability, okay? A liability. Sound good? But if you use some of your own money, we're going to call that some equity. We good with that? Now, what do you remember from your book that you're supposed to do when you see assets, liabilities, and equity? What is that talking about? It's some sign that goes, two signs that go there, one in particular. Yes, sir?
Assets equal liability plus equity.
Assets equal liabilities plus equity. That is your balance sheet. Assets equal liabilities plus equity. We good with that? So now, anything that you buy, you're going to buy it. Let's just say you buy it using cash. Using your assets. We know that one big particular asset we have is what? What's the very first one we think about? Say again?
Cash.
Cash. Money. Cash. So we buy some stuff with cash. We also have a promise to receive some certain things. Listen, I say it. A promise to receive things. I buy something from you. I promise I'm going to give it to you. And so you have a promise to receive. So you have what after cash? Accounts receivable, right? I'm going to make that C a little bit bigger. I'm going to come out here and put accounts because I want to focus on that receipt. Now, in my business, not so much in the gym, but in the restaurant, and I don't think as much in the event planning. But in the restaurant, you're going to sell some stuff, some food, right? Now, that food, whether it comes cooked or whether it's not cooked, you have to sell it. And you're going to take that food, store it in the pantry. When we think of storing it in the pantry, we're thinking about storing it in a what? Or storing it and calling it what? Inventory, because the inventory is stuff that we're going to sell, right? So we have inventory, stuff we're going to sell. Now, inventory is stuff we sell. And I want to make sure you understand it because this is something that I learned later. I'm talking about like way later, as in after I started teaching, after I passed CPA exam. So what I'm saying is you can pass this stuff and do this stuff, but not really know what it means. Inventory is stuff that you sell. I have here some markers. I have a computer. We have desks. All these are different types of what? Say again?
Equipment.
Kind of equipment, but we're thinking about equipment that we're short-term equipment. Let's say, they're not an official definition, but short-term equipment. Equipment that I use to help sell something. For example, I'm not selling you these, but it helps to see this. This kind of helps to sell. You know, I'm not saying everybody wants these certain things, but they help to sell the product. So these are things that we use to help sell. And so I'll help you out. This is called supplies, okay? So the difference between inventory and supplies is you sell inventory, right? But supplies, you use them to help to do other stuff. That's the key one of the key differences between equipment. That's a common one to get messed up. That's why I want to kind of talk about those, okay? So let's say supplies right here. All right. And then finally, here's something you can do. If you have a bill, right, and you pay up that bill in advance, have you paid it before or after? It sounds funny, but let's think. Have you paid that? You paid it in advance. Have you paid it before or after? Before, right? When you do something before, like for instance with football, we have the regular season, but before that we have the preseason, then we have the postseason. If you pay up something in advance, that is called a prepaid asset, okay? It's not the same as football, but think about it. You're paying it ahead of time, so there's really stuff you're going to have on hand. So that is a prepaid asset. All right. Now, I know I skipped this thing called debt investments, right? That is a type of current asset. Here's something I want to do to help you out. Because one of the things you're going to have to always do is to know what a balance sheet is, right? But then you're going to have to actually be able to record one or actually fill out one. So we call these current assets, right? No problem. Current assets. And it's going to ask you to give the current assets. One way to remember anything is always try to make it simple, right? The best way I can tell you to remember this. Now, I am missing one, but that's because it doesn't fit, but we'll come back in a second. Is remember current assets is things that are what? CRISP, they are what? Crisp. So when you're doing a balance sheet, you're talking about something that's crisp, sharp, right? You gotta have that current asset to be able to go and pay that liability right now. You see what I'm saying? So this is what we have. Current assets are crisp, right? Now we have the debt investments. So crisp with a D. And as long as you say crisp with a D, and remember where it goes, okay? Remember that it goes in there. But if you get that first part, I think you'll be confounded with the rest of it. Does that help you out in terms of trying to see where we're going with this? So your current assets, these are your current assets. These must always be in order. Now, why must they be in order? Because as we said the other day, cash is the king, right? And we want to be able to have cash anytime we need it. So cash, we don't have to worry about converting cash to cash because it is cash, right? The next possible thing, let's just start doing some similarities. I have some inventory. Let's see. You're going to sell her some cakes, right? You're going to sell her some cakes. Now, you can sell her some cakes, but she also came to me for, I have no idea, but I promised to pay you, right? Now, your business not even started, right? I'm sorry, your business not started. I got a job. You have a job too, but you know I got a job, right? And if I don't, you can go and sue for it. So, which one are you going to probably get the money from first? Me, from a receivable, or her who has to actually get clients and all this kind of stuff? Chances are you'll get it from me first, right? So which one is more likely to turn to cash, the receivable or the inventory? The receivable. So I use these examples about things we normally do and have, but I think that it'll help us to kind of see what's going on. Can y'all see on that side as well there? We only have a little bit of space and everything. So sorry about that. But hopefully you can see everything there? Okay, good deal. So I'm just kind of giving some things in case you don't remember Chris with a D or remember why, then that is why. That whole thing about which one turns to cash first is called liquidity. Liquidity has to do with what turns to cash first. All right? That's your current asset section. Now, you take all of these and add all these up, and that'll be everything that is in there. Make sense? Any questions? Take a second to think. Have any questions for a second? Did you get a chance to look at your homework a little bit so you kind of see this problem here, right? Okay. All right, now, we do have some more assets down there. We do have equipment. We have the patents and all that kind of stuff. But that's going to, it's not a particular order. You may have to do it on your homework, but when they talk about list your current assets, it must be in that order, okay? Sometimes you may get a little hung up on which one goes first. And I think that usually we are used to a certain thing, but in terms of this is a must. This has to be in that order, okay? Now, the balance sheet is probably, I hate to say one more important than the other because we need all of them, but in some ways it's a little bit more important. Let me see. If we have a business, right, we always think about an income statement. What do you think about when you think of an income statement?
How much money the business is making?
Right. Now, how do we figure how much it's making? We're going to sell some things, right? And those sales, when we think of sales in terms of accounting words, or especially when the bank, or anybody ever watched Shark Tank? They always ask you, how many have you had over the last year? What were your, starts with an R. What were your revenues over the last year, right? And of course, with the revenues, there's some things you have to take into account that you're gonna have to spend, which are some expenses, okay? So you have your revenues and you have your expenses. So over time, you're going to get all those together. I'm gonna let these up so we can see a little bit more here, hopefully. Okay, good. We can have a little bit more space. I'm not sure if this is going to work for you. Now, I feel so much better in here. I don't feel as hot anymore. Maybe I'm not. I don't know. It doesn't matter. Okay. All right. So we have a little bit more space. We talk about revenues and expenses. Revenues minus expenses is equal to what? How much we make, which is called our profit, okay? So we good on that part right there? Now, this is just for one period. This is for one period. What do I mean by one period? Over a certain amount of time, Usually now, at a minimum, you're probably going to see maybe a month's worth of time. Usually at a minimum, there'll be 1 month of time you'll see that, okay? But past that month, usually after that, you're going to see it quarterly. And then, of course, we know about every year what you make. But the thing is that it's for one period of time, all right? The difference between this and the balance sheet is as of a certain date, okay? As of a certain date. So you'll see something like this as of 12/31, which is usually the end of the year. This would be for the period ending. So if you ever kind of, if you have to think about those click down ones, this is what we have. This is at one point in time. Boom, I took a picture. That's how many we have. This here is talking about what happened over a whole period of time. It can have the same date, but this represents what happened over that whole period of time, okay? Now, as I said, this is for one period, but that's last year, or let's say that's 2 years ago. We had a profit. That's good, right? We didn't spend anything. We're not spending anything. We retained this money in the business. Key word, retain this in the business, okay? Then next year, we had another profit. That's what, and by the way, we do want a profit. I know there's going to be sometimes with tax purposes, you may do something, or your accountant may do something different. But that is, I hate to say it, but that's kind of like funny money. Like we talk about depreciation. You buy something, and then you allocate it over, you still pay that cash then. That's the purpose of the cash flow statement, but we're not getting to that. The biggest thing we want to know is that we're retaining some money in the business, okay? And you retain it for year one, you retain it for year two, and on and on and on. All the profit you do not spend is retained in the business, okay? So retained earnings, I'm going to abbreviate. Well, I got a little bit more. Retained earnings is all profit retained in the business, okay? All profit retained in the business. Now, of course, you know, if you had some last year, that's the beginning, right? And then you're going to have some that come from this year. You're going to add that in there, and then you have an ending balance. There's one more thing called dividends, but we'll get into that in a second, okay? Is everybody good so far? Now, we have profit, we have our income statement, and this is, we're talking about order of financial statements. This is the first one, okay? This here is the second one. The balance sheet will be number 3. Now, all this money that is retained in the business, or all this profit, I should say, because we think about money, think about cash, so say all this profit retained in the business, this is going to come here in this thing called equity. So just like we have current assets there, we have obviously stock there or ownership, but we have retained earnings in the business, okay? Retained earnings. So this is why this is what we have, what we did this year. We add on to what we had last year, and we consistently update our balance sheet as we go. That's the flow of the statements. That's why we have to do them in a certain order. And sometimes on some of your work, what you will see is blanks. You may have a blank here, a blank there, and fill in the blank. It's just trying to see if you can get to the point where you understand that this is the order that it goes in, okay? Everybody good so far? All right, now, since this is in here, well, let's go back to the balance sheet. Now we have a good understanding of the balance sheet. Let's see, they didn't give us, I erased it, so no problem. We know that we want to increase our assets, liabilities, and equity. And we want to be able to keep up with that, right? So this is something that I would really want you to write down. And like I say, this is your cheat sheet. In my opinion, this is one of the best things you can have. First of all, let's talk about assets, liabilities, and equity. When we write them down, we want to know if they're going up or if they're going down. So if I have some assets, and I owe some people, and I have equity. This is cash. Does this tell me if this is going up or down? You just know you have, now obviously you can look at last year, but just if you were to look at a journal entry, which is going to be our main part of the class starting in chapter 3, if you look at a journal entry, you won't be able to tell this by just seeing it. So we must devise some kind of way to say if it's going up or if it's going down. Have I gotten more inventory or equipment, but have I gotten more inventory? Have I paid up some things in advance? Have I increased that? The way we do that is they have this thing where they underline it and split it. Underline it and split it, and they call that a T account, okay? Now, under that T account, this is going to tell you, depending on what side I put cash, is the side that's going to increase or decrease, okay? So this is how you talk to people in number terms. If you can't say a word, then what you do is, if you want to show somebody that cash is increased, you write assets, cash, this right here, and then if you want to show it increase, then you will write cash on this side right here, on the left-hand side, which is debit. So the left-hand side is always going to mean debit. And I'm going to erase this plus. I'm going to come back in a second, but I want to erase this plus because I want to tell you something before I put that there. Left side of this is always called the debit. Always. Your left, when you look at your left hand, refer to your left hand as debit. Okay? This is going to be I think, studying as you go, this will be just studying as you go. The right-hand side is always going to be referred to as credit. Not as in buying on credit, but this is just the terms, like we say, left hand, right hand, left side is debit, right side is always credit. Now, does it always mean that does it always mean that left means increase and right means decrease? No. It's just what you call the left and right side. So, even over here, a liability, the left side is always going to be called debit. Equity, the left, is always going to be called debit. And the right side is always going to be called credit. And that's just the name of each side. Does that make sense? The left side is always called debit. As you see, there's an equal sign, which is very important to know, but there's an equal sign, no matter if it's on the left side or the right side of the equal sign, the left side of each account will mean that. Now, when you write your journal entry, I'm just telling you a preview, to show that something is a debit, you always put it far to the left as possible. Then when you credit it, you kind of indent it a little bit, okay? But that's later on. You don't have to worry about that, at least probably for a week and a half, okay? Any questions so far? Yes, ma'am.
So, you're saying, I'm trying to go here. Are you saying debit, like a debit card, or debit?
That's it, like a debit card.
Okay.
That's it, perfect example. Debit, just like the word debit now. Let me say this because this is confusing to everybody. I talk about banks, right? The banks, don't go home and look at your statement or whatever, or call and think that they mean debit and credit. Debits and credits and banks are totally different things. That is the number one thing that will confuse people. So if you have any kind of history with banking, meaning that you have a bank statement, credit card, or I got this credit back, they don't speak exactly this language with this right here. I'm talking about when you're going to borrow some money, but just your regular everyday account, that's a little bit different in terms of how they use that term. Does that help you out there? But that's one of the biggest things. It'll be confusing especially if you just really work in it. Once again, when I say talking to a bank about assets, liabilities, and equity, revenues, and expenses, I'm simply talking about the fact that you're going to try and probably go do some business with them. But when they talk about your actual account, it's different. And just to make it a little bit more understanding, think about it. They're the opposite of you. So of course, if you come to me and tell me to hold your money, then I'm not going to call it the same thing you call it. So the bank, that's the reason a little bit different, okay? But yes, D-E-B-I-T, debit, as in debit card. Uh-huh. Everybody still okay? Now, and really, what you really are learning is chapter 1, 2, and 3 right now. You only have homework for, obviously for chapter 1 or whatever, but you're really learning chapter 1, 2, and 3. But I'm giving it to you because if you would take this and this and this and everything I have here and write it, I'm going to say twice a week. By the time you get, probably how many times you need to, by the time you get to your exam, if you write this on your exam, you have everything you need to pass the class. I say that because as you keep going, especially chapter 8, 9, 10, 11, we start getting a whole lot of new accounts. You'll get some in chapter 3 and 4, but as you get new accounts, they're all going to somehow fall under assets, liabilities, and equity. Somehow, that's where they're going to fall. I say that because even though the income statement is its own thing, it still ends up where? Under equity. So however I increase equity, I'm going to increase these revenues the same way, or the expenses to decrease them, okay? Now, let's finish back one more point. And this is really the last big point. Everything else is now just mastering this, okay? To show that I increase assets, we said we're going to, I'm going to put that plus sign back there, plus there. That means I debit an asset to show that it's increased, okay? I debit an asset to show that it's increased. I'm going to let it sink in for a second because everything else is going to be easy. I debit the asset to show that it increases. So if you owe me money, right? Then if you owe me money, that's the accounts receivable. So I need to put your name on which side? This side or this side? That side, right? You know what I'm saying? Now, I have his name, now I have your name. So I have two names of people that owe me money. That's increasing my assets because an asset is a promise to pay. I'm going to receive this cash, obviously some of the current assets within a year, but I'm still going to receive it, right? And so when I receive it, it's basically the same as, I can count that as cash because it's pretty guaranteed. As we'll see later, there are going to be some ways you account for stuff that's not always paid, but in essence, it's guaranteed. So every name I have from which people are going to give me money, I increase these assets as accounts receivable. Biggest thing is any asset, as we keep going, equipment, patents, anything is an asset, we're going to increase it with a debit, period. Anything that's an asset, we're going to increase it with a debit. Now, let's move. You see this equal sign, right? That means that if I have this hand this high, how high do I have to have this hand? Tell me when I'm equal. Do what? I'm past now, so about right here, right? So whatever I do on this side, I have to do something similar. Since I passed, I have to reverse that and bring it back down to make it equal, right? So if I have the left side going up every time, then how do I show over here that these increase? The opposite. Okay, so if I show increase of any asset with the plus, then I have to show an increase of a liability on the left side or the right side.
The left side?
Say again?
The left side?
Not the left side because I'm still, the left side is still going up, okay? I want to show that, let me put this right here. Just take this one. If I want to make this side equal to this, I'm going to put another plus sign over here or a brand new one over here on the right side. So all we want to do is come over here and take that same thought because we're not worried about whether it's an asset liability right now. We're thinking about the fact that that's an equal sign. Like one part of my body. So this is like one part of my body over here. There's one part over there. So I have to use the opposite side to make it show an increase. Does that make sense? So that means I'm going to show if I show an increase with a debit for assets, how do I show an increase with a liability for equity? And how do I show an increase on the liability and equity side? Using a what? A plus sign on the debit or credit side? Credit. Good. Now, why is that? Because that equal sign is there. So you can do it you can learn this and that's fine. Learn it this way, or you can just remember that I always increase assets with a positive. So whatever I do on the other side, the equal side, I have to do something to even it out. Okay. Now I'm only worried about increasing because you can't do but one more thing is decrease. So we can write that in a second, but as long as we know the increase, that's good. You're going to see later on that that an account has a normal balance usually if it's increasing. Okay. So the side that it increase on is the normal balance. Why do we say normal? Because if we see that it is supposed to be increasing, and it is, that's normal. Like my bank account, I want to see an increase, right? So long as I see money going up or on the positive side, that's normal to me. What's not normal? On the credit. So if I see, whoa, there's something wrong with it, I need to go ask some questions. I need to see what's going on, right? And the same thing here. If you do a journal entry or if you do something with your accountant and somehow you have an asset that is credited, you need to ask questions. There are certain times now, but just in general, the overall balance should be positive on this side. So if I have some inventory, the overall balance of inventory should be positive or negative? Positive. Think about it, I can't have a negative balance of inventory. I can sell some and take it off, but the overall balance is going to be positive. The overall balance is going to be positive, shown as a debit. Okay. Sound good? Any questions? With the gym, with the restaurant, with the event planning, is that kind of put some things in your mind to think about? What about us? Anybody else have any businesses? Are you thinking about opening? Does it seem as hard to open a business now since we started to see how this works? So, anybody want to open a business over here? Y'all don't want no money? That's all right. We'll just go over here and eat, right? Have a good time. Let them do the work. But we got to pay for that work. Oh, well. We'll just go work it off in the end. Yes, ma'am.
I thought you were asking somebody else wanted.
Oh, yeah, sure. Okay, yeah. What type of business would you like to open, if it's okay?
I'm not a business major, I'm just a minor.
That's okay.
I was wanting to do like something graphic design related.
Graphic design related. You're still going to have, obviously, we have the cash, whatever. You're going to have some inventory. You're going to have computers and all this kind of stuff. So this all relates. It's okay to buy, credit is good and bad, obviously, depending on how we use it. You're going to have possibly some liabilities because just think, if you're just starting, if you can borrow some money from anybody and keep your cash on hand for emergencies that may come up, that's fine. Obviously, you want to do your pro forma to make sure that you're going to be able to pay for that, but it's okay to have those at first. So no, like we said earlier, we don't have to invest all our money in it to start with it, okay? But I'm not saying go out and do like you see on YouTube either now. Well, they make it sound real good on YouTube, but if they were that good, I think they'd be selling this stuff other than giving it to us for free, right? Well, I say that, but you know what I mean. All right. Everybody good so far? All right. Any questions? All right, let's look at something for a second here. We're going to fill this thing out. So if you have a piece of paper, what I'd like for you to do is to write assets, liabilities, and equity on a sheet of paper. Write it just like that. Write it just like that. Then at the bottom, or if you have some space somewhere else, I want you to write revenues and expenses, but put them not on top of each other, put them beside each other. Similar to this right here, just write revenues and expenses. But don't worry about profit. It's fine if you write that, but as long as you have those 5 categories, assets, liabilities, equity, and then either revenues and expenses in some way, that's going to be fine. It can look like this right here. It's no right or wrong way. Obviously, this is always going to help us to remember. And I don't want you to think, I want you to think of this as totally different. Don't worry about that's down here. Expenses, and we just keep those right now, okay? We'll talk about retained earnings, but let's think about that. Now, I'm going to call out some things. I simply want you to put them in the correct place. This here, as we said earlier, is a balance sheet. And this here is an income statement, okay? So let's just think about those, okay? Now, when I call out these things, what I need you to do is to think about it for a second, write it down, and we'll come back and see if you're right. I want you to know, oh yes ma'am, I want to know which ones these go under. Yes ma'am.
I was going to ask what's that green word about under the revenue and expenses?
Oh, that's I'm sorry, that's a little bit lower. That's income statement. Those who can't see under the revenues and expenses, that's income statement, okay?
What was your question that you wanted me to answer?
Oh, right now?
I thought you asked me a question.
Oh, I'm sorry. No, ma'am. I probably accidentally asked one. I'm sorry. Okay.
All right, I was going to try to answer it.
Oh, yeah. I don't remember. Y'all help me out. Did I ask? I hope I don't even want to know if I just messed up and thought I did something. Whew. All right. Here's a question for you all. I'm going to give us about 10 or 12 things. I want us to write these under where we think they go, okay? I'm going to give you some. If you think it's an asset, you write it there. If you think it's an expense, you write it there. Income statement, so we can always just associate certain things. But I want you to think about where these go, okay? So if I talk about income tax expense, don't say it out loud yet. Write income tax expense wherever you think it goes. Wherever you think income tax expense goes, okay? What about inventory? Inventory. Which one of those places does it go under? Accounts payable. Accounts payable. Just to give you a hint, we have accounts receivable. Now we're talking about accounts payable. This is going to become clear later on, but just don't, matter of fact, put a star by that wherever you put it, because it's easy to mess up, when you first learn it. So put a star by that. We're going to have accounts receivable. I'll tell you to put a star by that as well. But right now, accounts payable, put that where you think it goes. Now, as I said the other day, it's not a tricky question. It's just remembering where it goes. Where does retained earnings go? What do we think that goes under the income statement over there, or the balance sheet? And if you can tell me which one it goes, and that's even better, okay? What about equipment? Equipment. All these are going to either be assets, liabilities, equity, revenues, or expenses. A balance sheet is assets equal liabilities plus equity. That's it for a balance sheet. It's just a matter of, are we going to show an increase or a decrease, and that depends on which side it's on. What about sales revenue? Sales revenue. And we can just take the sales off and say revenue, just as long as you remember revenues, that's going to be the key word. Now, here's one that you haven't seen yet, probably. It's cost of goods sold. And I can take the restaurant and probably make the best example out of that. With the restaurant, you're going to buy some stuff, right? And you're going to buy that, and we talked about that. We're going to put that in the pantry and call it inventory, right? When you sell that, that is now a cost of doing business. So cost of goods sold is going to be an asset, liability, equity, revenue, or an expense. You probably haven't seen that one yet. So don't worry, don't feel bad if you don't know it. Don't feel bad if you know any of them, because this is the first fake quiz we're doing, right? It doesn't even count as a quiz. It's a quiz for you, okay? Next, common stock. Common stock always talks about ownership. We're going to have preferred stock later on as we go, but common stock, preferred stock, any type of stock, we're talking about ownership. So earlier when we talked about buying something, we talked about buying it on credit with a liability, or we talked about using your own, and you can get that answer right there, okay? And lastly, we have interest expense. Interest expense is what we have next. Interest expense, all right? All right, now, let's go through. What's the first one we have? Somebody, I can't see that far. What's the first one we have? Income tax expense, that's the first one I have? Inventory, okay, yeah, it's the first one inventory? We gotta do both of them. How about we do both of them? We'll do inventory and income tax expense. Let's do inventory first. Where do we put inventory? Assets, good, okay. What type of asset is this? A current asset or a non-current asset? Current, good. Keep that in your mind, okay? And we said income tax expense, right? So income tax expense goes where? Under expenses. I'm going to abbreviate income tax expense. All right. What else do we have? Accounts payable. Here's a tip. Whenever you hear payable, this answer is always going to be in that category. Where did you put accounts payable?
Expenses.
Almost. Liabilities. That's okay. Liabilities. This is why we're going through this. This is one of those things, and you can put, if you make groups out here, I may put a star because they're easy to mix up. And so expenses and liabilities are easy to confuse. Okay? So what was it that you what was it liability? What's liability was? Accounts payable. Accounts payable is this liability here. Now, this is called a current liability. So you can put CL right there. Current liability, okay? Making good time. All right. So this is a current liability. Now, I'm going to give you something. This is not something I think that's in your book, but like I say, it took me to graduate and start looking at to understand. If you want something that's going to help you out, I have a phone bill. Phone's here. I have a phone bill, okay? So I have to pay a phone bill. That is a phone bill expense, right? How do I pay that phone bill using what? Cash, which is a what? An asset. So let's think of this right here. An expense always uses an asset. Now I can put that spend. I can obviously use cash, right? Let's just say if I knew you personally and I said, well, I don't have any money, but I can give you some of my inventory, and you accepted that, I'm still giving you an asset, right? So an expense always uses an asset. An expense always uses an asset. Whenever you'll see later on, whenever you put the word expense, it's always going to have with the use of an asset either now, using cash, or later with the payable. So an expense always uses some type of asset, okay? Excuse me. A liability is a probable future economic sacrifice. Just because I have that bill, does that mean I'm gonna pay it? I'm probably gonna pay it, right? But it's a probable future economic sacrifice. So those are pieces of the real definition, and I don't think at any point in time in school they get into those real definitions of these things, but the real definitions help. But the expense is always going to be associated with the use of an asset. A liability is a probable future economic sacrifice. If I go out of business, you're not getting it. If I want a burger, you're not getting it. It's always probable, okay? Is that kind of helpful there on that one right there? Because that's an easy one to mix up. So these are some that are easy to confuse, okay? What do we have next? Equipment. What do we have? Where we put our equipment? Assets. What type of asset? Is it current or non-current?
Current.
Okay. And what we're going to do is we're going to go through without looking over there, what's our acronym? What's our thing we're going to help us remember? CRIS. So, with the D, but we're not worried about the D right now. What does this stand for right here? Well, I'm not going to write it. We're just going to, I want you to think about it as you go, because just like you remember that, at the very least, when we get there, we can see if it falls under any one of those right there, okay? So don't write it down. Don't write what it means. Try not to look over there. We're just going to try to go from memory right now. All right? What do we have next?
Sales revenue.
Sales revenue. What does that go under? Assets, liabilities, equity, revenue, or expenses? Revenue. That's easy. No problem at all. Revenues, okay? So this is going to be a little bit lower. I'm sorry about that. Sales revenue. It goes under revenues, okay? What's next?
Retained earnings.
Retained earnings. Now, let's go back to this. We have our income statement. Revenues minus expenses is how much we made profit during one period of time, right? If I start to accumulate stuff over time, I'm retaining that in the business, so that will be called retained earnings, right? And then we talk about retained earnings eventually go to equity, correct? So retained earnings goes under equity, all right? Retained earnings goes under equity. Good. If it asks you in terms of a balance sheet and you don't see equity, remember, this goes retained earnings goes to equity, and that goes to balance sheet. So as long as you remember that way, you get, depending on what they're asking, you'll be in the right, you'll have the correct answer, okay? What else do we have?
Cost of goods.
Cost of goods. What's the best guess we have on that one? Expenses, right? Because we're using up part of that. Remember, that's inventory that we bought that we're going to sell now, but we pay for the inventory. It's an expense. So cost of goods sold. I'm going to abbreviate that right now. Cost of goods sold. Okay. What else do we have?
Common stock.
Common stock. Stock of any type has to do with what? Equity, ownership, equity, and so you're correct, it will go right here. I'm just going to put stock for right now because later on you're going to see preferred stock, treasury stock, all different types of stock there. So stock, and it always has to do with ownership. What else do we have?
The last one is interest expense.
Interest expense, and that gives it away as which one? interest expense. And no matter what goes on with the balance sheet, this must always equal this side. That's not a problem that was given, but you know, you can think about, you can probably make it work. There's no numbers associated with it. But you bought your inventory, you use some of your money, which is ownership, stock, so you have stock in what you had, and you probably pay you probably pay for your equipment on cash, that's probably a little bit harder. You probably pay for your equipment using a liability, that's a little bit harder. And right here, you probably bought some inventory out of what you own and maybe some leftover money in the business of previous times, okay? So that's just kind of showing that it's always supposed to equal. We don't even go in debits and credits in chapter 1, but just getting that foundation. So what I would say, once again, is I would write this every day, or not every day, if you can, but write that just assets equal liabilities with equity, this right here, because every time, as you see, now that you have inventory, you know the inventory goes over there, and inventory increases using a debit or a credit. Which one increases inventory? Debit, right? All we do is just transfer everything over there to over here, and that's what we have. Okay? Any questions on that part? All right, we'll do this one together. Accounts receivables. Is it an asset, liability, equity? I'm gonna give 3 seconds, then we're gonna say it. Is accounts receivable an asset, liability, or equity? 1, 2, 3. Asset. Good. Liabilities. I just gave you that answer. I can't give it to you. Ha. Supplies. Think about it for a second. 1, 2, 3. Supplies is a asset. Good. Preferred stock. Think about it for a second. Preferred stock is a 1, 2, 3. Equity. Perfect. Notes payable. Remember that payable always goes somewhere, right? Notes payable. Liability. What about salaries and wages payable? Liability. See, that's what I call the choir. You know how somebody be off tune and they get a wrong answer? I didn't hear none, so that's good. Now, if you knew you were off key a little bit, that's okay, as long as you're off a little bit, right? It's not time for a performance. You got to get this stuff down pat. So just practice it. Go home and practice it, and it's going to work out for you, okay? So be honest with you. I mean, it's on the screen. You can walk by and see, but you can't take a picture. I just went over your exam prep for chapter 1. It's just that easy. I mean, I say just the easy in terms, we got to go home and put it to use and everything. And as you start to see stuff, you're just not going to see stuff the same. I've heard of people like engineering majors, they'll go by and see that building over there, and instead of seeing a building, they seeing all kind of angles and stuff, because it's just what you see. Or people that's, in medical fields, they don't just see a body, they see hearts and veins and stuff and looking at people. So you're going to see these things a little bit differently. So it's not anything that you haven't heard before. It's just now putting stuff into words and practicing the homework, because the homework really, like I say, no matter what system even if I wrote a test from scratch, you still gonna have to do a debit or a credit. It's just gonna be maybe in my handwriting or typed or something like that. So I went over basically a chapter 1 review because it's no other way we can do it. So that's pretty much it. Okay. Chapter 2 is very, very similar to this. I'm going to pull it up for a second here. I would definitely encourage us to go through the chapter 2 PowerPoint this weekend or before the next class starts, because that is basically our whole lecture. This was a lecture too. It's just it's just a part of what we did together. Okay, so chapter 1 it'd have been boring to do a PowerPoint for chapter 1, because really with chapter 1 PowerPoint, let me see, it's not a lot on there. It's kind of boring. So this was your chapter 1 presentation. Every other one is on there, which means we can spend more time doing this. But as you see, this is the lecture and the homework. So they kind of go together. Your questions will look just like what we talked about. I can talk about chapter 2 just as a brief overview. Classified balance sheet present. Oh, let me pull it down for you so you can see it. Let's pull it down there. And we're not going through it, in detail, just kind of showing you that how much we covered today, okay? Oh, it's warming up. I don't know why, but still working. Okay, there it is. Just to remind us when it gets on here, the audio, in cases where the audio, there'll be a certain place we would put it, and I probably pull up the wrong one. I pulled up the one without the audio, but it's taking a while to come up there. I might can switch it out to go to the one with the audio. Wow, that's working there. Okay, so maybe it's not going to come on today. Well, good thing we didn't need that PowerPoint because it's not playing, but I can go over the PowerPoint with us. We talk about the classified balance sheet. It's a point in time. That's what we have. We had a period of time over there, a point in time over here. Then it talks about the standard classifications. Now, we talked about the current assets the other day in terms of them being within 1 year. That was no problem. The current liabilities, those are things we talked about. So we talked about a lot pretty much that has to do with chapters 1 and 2 already, okay? So next time we'll try to focus on doing some chapter 2 questions as well, okay? So as much practice you can get it in. At the very least, as you're starting to look at things, especially you who want to do businesses of your own. When I took a class similar to this right here, I started to kind of make my own little thing. So I think one of the best ways to learn is that if you're thinking about a business or if you want to work in a certain industry, here's the thing about it. If you don't want to own your business, if you want to be a manager of any sort, you still have to talk to the people about what to order, right? So you won't be going and talking about debits and credits, but you can always have a better way to make your case. And if you can make it the case in terms of accounting terms, just what equals what, where does this come from? You're going to make that case and you don't have to worry about dealing with the debits and credits, okay? So that's the importance. So if you have a business, great. Use this class to make a business plan. Trust me, it's going to change if you stay in accounting. If you don't, it's going to change. But just putting it on paper is always good, okay? That's what I would encourage you to do over the weekend, not just make the plan, but as you go through this course, do that. And then if you have questions, ask me. You see what I'm saying? That's where I can kind of help you out a little bit. But I think that's it for today. Any questions?